Welcome to the TechMediaWire Podcast powered by IBN. This original audio production delivers market and sector insights, as well as exclusive interviews with innovative executives shaping the future in fast-moving industries, and may feature a client partner of IBN or one of the 60-plus investor-focused brands within IBN's dynamic brand portfolio. As a multifaceted financial news and publishing company, IBN leverages its extensive distribution network, utilizing multiple proprietary corporate communication tools to introduce both public and private companies to a vast and diverse audience of investors, consumers, influencers, journalists, and other targeted segments of the public. IBN may have received compensation to produce this audio content. Please be sure to read IBN's entire disclaimers for full disclosures. Now, sit back, relax, and enjoy the next revelatory episode of IBN's TechMediaWire podcast.
Hi, and welcome to another exciting show here with me, Carmel Fisher, where we bring you all the revelatory news on breakthrough companies doing fantastic things out there in the capital markets. Today, we're spotlighting Beeline Holdings, Inc. They are listed on NASDAQ as BLNE. With me is CEO Nick Liuzza. Welcome, Nick.
Hey, thank you very much. Happy to be here.
Yeah, excited to catch up once again. We did speak not too long ago, and we're excited now because there's more recent developments. But just to bring the audience up to speed, Beeline is a pioneering mortgage fintech company with a digital AI-powered lending and title platform. Headquartered in Providence, Beeline is transforming home loans, making them simpler, faster, so that everyone can have more financial freedom through their property. This sounds very exciting, as I said in previous interviews, so relevant right now. But before we dive into a little deeper conversation about strategy, etc., tell us more about Beeline Holdings, what the mission and vision is, and why you found this niche.
Well, look, there's 75 million millennials out there. Those guys grew up with these phones, right? They had them in their pockets when they're 6, 7, 8, 9 years old. And then there's 25 million Gen Z behind them. Almost a third of the population grew up differently than when the mortgage industry created their products way back in the day. So enter Beeline, which has designed a brand, a product, and real-time information to address this market, not only with faster, better, more credible information, but also a wider variety of products versus the other mortgage lenders, so that A, we can convert better, and B, we can give real-time information that's consistent and accurate 24/7, 365. Again, that generation grew up with these phones, and that's what they require to do business.
Absolutely. So moving a little bit to more of the executive alignment, capital allocation strategies, your leadership team just made significant personal investments. The COO purchased 100,000 shares, bringing your personal stake to over $16 million. Tell us a little bit more about this. This insider buying coincides, right, with achieving debt-free status ahead of schedule. Tell us more about that.
Yeah, it's important for us and as a leadership team to stand side by side with our shareholders. I mean, literally, we are in the trenches and we believe what we do and we put our money where our mouth is. Yes, I have $16 million in the company. Our COO has several $100,000 in the company. Our CFO's vested. Our management team in Australia or our product team in Australia are vested. So, we believe in what we're doing. And as a result of that, we've written checks to buy shares and grow the appreciation and recognize that appreciation as shareholders.
So as I mentioned, this insider buying obviously coincides with you having achieved a debt-free status ahead of schedule. How are you going to balance this aggressive reinvestment in AI and product development with the capital discipline that got you debt-free in the first place? Firstly, congratulations on that. And then let's just get an answer to that question.
Yeah, thank you very much for that. Look, we're very happy about that. We entered the year 2025 with $7 million in debt. Our goal was to be debt-free by the end of 2025. We actually achieved that goal on September 5th. We are debt-free on our way to cash flow positive for Q1. And look, we achieved that through discipline and, concerned about our bottom line and concerned about incurring more debt and being careful with what we do. Our big spend is really, you're always spending on tech. It never stops. But really where our big spend happened was when the market was bad. We were losing almost $1 million a month. And that's because we kept our foot on the gas pedal and we kept spending, developing, creating to execute on our vision, and the market was horrible during those 3.5 years. I mean, absolutely horrible. And we knew we would kill our balance sheet, but we also knew the window would open. And when the window opened, we had to be ready with a model that was unique and different. And that's what we have done, and that's what we have built. So we will always invest in technology, and we will continue to do that. But in the mortgage space, and now that we have tailwinds, and now that we're going to reach cash flow positive, we can fund that development through our earnings. But also, and when we raise money, we can raise equity in the market at stronger valuations to help support our growth.
Yeah, very delicate line to balance there. And here's another question. In all of this, getting cash flow positive, investing in technology, always, as you say, much needed. You've got to keep growing and keep developing. But what is your framework then for deciding between returning cash to shareholders versus funding growth initiatives like your Magic Blocks expansion?
Yeah, look, I mean, as a high growth company, I don't think there's a plan to return cash to shareholders as a dividend just yet. I mean, we're more concerned about growing capital appreciation and growing our stock. And we know we can do that by, disrupting the largest private market in the U.S., right, which is the U.S. mortgage industry, right? And so the whole goal is to leverage AI so that we can close more loans per employee. An industry where most typically lenders are closing 2 to 2.5 loans per employee per month, which is not a very good outcome. And that's because these legacy softwares, these legacy systems, they're cumbersome, they're sleepy, they're tired. In some cases, they're even DOS with some lenders. And so by leveraging AI and getting to 6 to 7 loans per employee per month, which is what our goal is, and we are already starting to see a lift. We're going to put ourselves in a position where we can grow our stock pretty significantly if we're outpacing and growing our bottom line faster than the industry is. And how do we do that? Well, we're leveraging AI. As an example, our AI chatbot, which is now a sales agent as well, is converting sales leads 6 times better than a human being would, right? And so that has a significant uplift because the bot is on 24/7. The bot is a lot less expensive than one employee at the end of the day. And that, the bot never takes a break. He's always on. He's converting way better, and he can scale. So the opportunity is infinite as it relates to taking this technology, this AI technology, and moving it through the back end of the process. You start with the front end, which is the sales piece, and you move it through the back end. And we've already started that development. We're much better at what we're doing. We're much better at moving that AI and understanding that AI and implementing it than we were, several years ago. And so the cost is not as great. Now that we've developed a bunch of it, it's ready to scale. And the really significant cost is kind of behind us, if you will, and it's not in front of us.
Great stuff. So, you're speaking about, I believe it's Bob, who's your AI chatbot technology. Obviously, as things become commoditized across the mortgage industry, what specific proprietary advantages will prevent competitors from replicating your AI-driven efficiencies?
Well, listen, we're not too concerned about replication. We know that's going to happen. And we know, look, there are several other mortgage lenders that have really sophisticated bots like we do. What we're doing is just trying to stay ahead of our competitors. And that's important. But the most important thing really is to ensure that your ROI and your bottom line is benefiting from your spend on technology, and the AI is making a difference. Closing 6 or 7 loans per employee per month versus 2, that has a huge impact on the financial condition of your company. And so what we see is our AI moving toward the back end of our process, right? And so now, from a processing standpoint and an underwriting standpoint, we're able to get through files much faster by extracting data using AI, completing tasks, starting tasks, using data that typically a human being would do. We're able to do that faster, quicker, and in a way that you weren't able to do it prior to AI being an option. So, we're not too concerned about replication. We're more concerned about our own P&L and growing our own market share and leveraging our own AI to get there.
Makes total sense. Now, in terms of Beeline equities market validation and the scaling thereof, you've completed the first token-backed fractional equity sale and expect about 10 to 15 more transactions or at least before the October launch, right? What are the early learnings from these pilot transactions?
That's correct. We're learning a lot. Look, this is groundbreaking stuff here. I mean, we're not talking about doing just a couple transactions here. We're talking about at scale, which is a significant amount of business. The zip codes that we're focused in on have about $10 trillion of equity available, and in those zip codes, those consumers are having a hard time, for the most part, qualifying for cash out refis. So we've targeted areas where there's available equity and when there's high demand. And so leveraging a partner that's going to mine a token supported by the public record in order to fund these transactions, which is a sale of equity at scale, it's not being done by anyone else out there, right? And so what we want to be sure is that the product meets the mark, which it does. The product is in high demand, which it does. But most importantly, it doesn't affect the market in an adverse way. And so, and we also want to make sure that we're not delivering crypto to our borrowers. We're delivering cash. We're leveraging crypto through a partner who turns that crypto into cash, delivers the cash to us, and then we fund the cash. And so there's a lot of moving parts there. And again, talking about doing this at scale, it's not an easy piece. So it's very important that these first 15 to 30 transactions are done appropriately, properly. We understand where the pain is and where the potential problems are. And that's the phase we're in right now. We're closing these transactions, we're analyzing them, we're understanding them, we're building streamlined processes. The software is built. It's just now a function of enhancing it and ensuring the funding is in place, and then we're ready to go on a larger scale. So all that is on target. We expect to go to a broader outreach toward the latter part of October, maybe the early part of November. But as far as the beta transactions, those are happening now, and a larger scale will happen, sometime in the next 30 to 45 days.
Sounds all good. Although there's regulation easing, so to speak, around this industry, what other concerns may you have around tokenized real estate that may impact the scaling timeline?
Well, that's a really good question. That's one of the reasons why we've been careful to launch and been careful to ensure that the programs that we are developing are benefiting and not being adverse to a consumer. And so there is not a lot of regulation around what we're doing. If you think about the fractional sale of equity, those products are under fire a bit because a lot of the companies out there are not truly doing fractional sale of equity. They're not recording a deed. They're recording a deed of trust. And so the product looks like a reverse mortgage in some respects, and not necessarily a sale of equity. Ours is a pure sale of equity. And what we've learned being in the business for so long, that if you do the right thing for the consumer and you're fair and you're honest and you're transparent and your costs are market and in line, then generally you don't have a compliance issue, provided that, the rules, you're not breaking any rules. Right now, there are not a lot of rules. So we're just trying to think about and anticipate what a regulator would regulate in terms of this particular product. The crypto piece is a whole nother world. And again, Beeline is not mining its own crypto. It's delivering a deed, and our partner is mining crypto to dollar for dollar for that to that deed, and then turning that crypto into cash and delivering cash to us, and we're funding the transaction. So I'm not so sure we're going to be regulated on the crypto side, but there is going to be, I think, more regulation on this fractional sale of equity piece. And our product is a true fractional sale of equity. It never turns into a note or a loan. The payback period is determined only by the sale of the property, and at that point in time, the equity is paid back. There's no the investor has no rights to the property. They are a minority stakeholder. They sit on title, and at the end of the day, like I said, they don't get paid until that property is sold.
All right. So given some of the complexity that you have touched on for this product, what would you say is the realistic revenue contribution timeline?
Well, that's something that, I can't really comment on, only because it's not a matter of public record just yet. And, we're not quite ready to provide that information. But I will say that the market is massive. And the opportunity is massive. Like I said, there's $10 trillion of equity available in the market. And I think I've already disclosed that Beeline will make about 3.5% on a per transaction basis. So I can tell you that for every $300,000 sale of equity done, which is the average transaction we're targeting, that would be about $9,500. Is that right? Yes, for Beeline. So it's about a $9,500 to $10,000 per transaction at the end of the day.
All right. We'll keep our eye on that. Thank you for giving a little bit of clarity there. So in terms of market timing and profitability and your path to that, you're targeting a cash flow positive operations by Q1 2026, as we discussed, just as Fannie Mae and MBA are predicting mortgage market recovery. Now, your Q2 results show 27% sequential revenue growth, but the broader mortgage market remains constrained.
Yeah, look, I mean, 27% revenue growth from Q1 to Q2, I mean, look, that's not, in our view, that's it's not great, right? I mean, it's 27%. We're a small company. We want to see much more significant growth than 27% per quarter, and we will. The market's been challenging, right? Especially for small lenders, right? At the end of the day, those headwinds have been significant. The fact that we have a diversified platform and we're doing a wider variety of loans than most conventional lenders do does give us a bit of an advantage because we're able to convert better because we offer more products than the top 50 lenders do at the end of the day. So when you think about revenue growth, now that rates are starting to come down, you're seeing a very strong purchase market for August, right? There's going to be more transactions out there, and a company like Beeline is positioned to capitalize very quickly. So we expect very strong revenue growth starting in Q4 and going forward. And so, while we did see 27% from Q1 to Q2, I think that we're expecting much more robust numbers than that on a going forward basis.
Looking at Magic Blocks now, we'll ask you just to dive a little deeper into that, but we do see that you've launched with 18 live clients in June. Beeline retains a 47% stake. Looking at the broad applicability of your one-click AI sales agent beyond mortgage lending, what's the strategy for monetizing this?
Yeah, listen, great question. I don't think I've been asked that question, actually. So, we decided to take our technology that we developed for our chatbot and roll it into its own company and create a more sales-focused bot that could speak someone's brand and go out there and convert sales leads into business on an international scale. And so if you think about that, right, for a second, it's like the mortgage US business market is really big, and we have this technology to convert, which I mentioned, we're converting 6 times better. But if you think about now taking that and put it into its own company and building a platform where anyone in the world in any language can come to our platform and through a series of administrative prompts and uploading data and documents on who you are and what you do as a company, in just a couple, in just an hour and a half, you could have your own sales bot live and ready to go that will speak your brand. Obviously, the first day won't be as good as the 30th day because the AI gets better as it learns, but you can have your own sales bot out there ready to go at a fraction of what it would cost to hire someone. And the ability to scale it is off the charts. And so when you think about the fact that every single company in the world needs to drive revenue, and almost every single one of them has to drive revenue through some sort of means, and by offering this to the entire world and in their own language and a platform where you can come to and do it at any point in time, we saw an opportunity and we decided to create Beeline Labs, which is a division of our company that's going to grow technology primarily in the mortgage space, but in this particular case, it's international and it's not just related to mortgage, but primarily in the mortgage space, Beeline Labs, to create more value for our shareholders, create another revenue stream that's not tied to interest rates, and create value at the end of the day that other publicly traded mortgage companies don't have. So, I mean, it wasn't a tough decision, and the fact that we launched with 18 clients. Only half of which are US based. That was June. I think we probably have 5 to 10 more clients by now. on Magic Blocks. It's just a really good opportunity, and we seized it.
Fantastic. Will you be considering an additional or separate funding round for this, or even an IPO?
I don't know about an IPO anytime soon. It's a very early stage company at this point. The company has committed funds from private equity, and it's based in Australia. So a private equity fund in Australia has committed to fund that company. Beeline recently wrote another $250,000 check to increase our stake a bit, and we did do that. And so I don't think the company is going to have any problem raising money. And also it has a very good profitability model. It can run lean. It uses AI to do onboarding like you would expect it to do. So its cost per employee is much lower, and its revenue per employee is much higher than most companies. And so at the end of the day, it's going to be a company that's going to get to profitability very fast, and it's a company that's going to be able to grow revenue very fast.
Fantastic, Nick. Thank you so much. Always great catching up with you and keeping up to date with the developments at Beeline Holdings. We'll probably be catching up again soon with Nick Liuzza, CEO of, as I mentioned, Beeline Holdings, Inc., with NASDAQ as BLNE. Stay tuned for more, you guys, and stay safe out there.
Thank you very much. It was great talking to you, Carmel. You take care.
The TechMediaWire Podcast is an original content production powered by IBN, a multifaceted financial news and publishing company that delivers next-generation corporate communication solutions. Utilizing proprietary corporate communication tools such as news aggregation and syndication, social communication, and brand awareness techniques, among others, IBN introduces both public and private companies to diverse audiences to enhance reach and recognition. IBN may receive compensation for services and solutions provided to its client partners. You should assume that the owners, officers, and directors of IBN or financial analysts mentioned in this production may hold a position in and may intend to trade the securities in their own accounts. This production is not an offer or recommendation to buy or sell any securities that may be mentioned in this production. The information in this broadcast is presented solely for informative purposes and is not intended to be or should it be construed as investment advice. As in all investments, investment in the featured companies carries inherent investment risk. Listeners should review the companies thoroughly with a registered investment advisor or registered stockbroker. This production by IBN is not purported to be a complete study of the featured company or other companies mentioned. Information used in statements of fact have been obtained from featured companies and other sources but not verified nor guaranteed by IBN as to completeness and accuracy. Such information is subject to change without notice. Please see IBN's full disclaimers and disclosures at www.ibn.fm/disclaimer. Music in this episode is by Infraction. For more, visit inaudio.org.